All right, everybody. Welcome to another learning session. We're going to be going over financial statements 101. We're going to go over the three financial statements, which makes up the bulk of your business. We're talking about your profit and loss statement, your balance sheet, and your cash flow statement. We're also going to throw a little extra report in there depending on the time. So yeah, pretty much let's get into it. So let me just share my screen. See what we got. Even go into the numbers. Pretty much there's just certain metrics that you're going to want to make sure that my screen is showing. All right, perfect. So pretty much we just want to make sure that we have certain metrics that we're always considering on a profit and loss. So you're going to have your real revenue, which is all the money that you make from all of your revenue line items. So whether you're offering storage, move revenue from local to long distance to commercial, cleaning services, no matter what type of revenue you have coming into your business it should be located in your revenue. Even tip revenue should be in your revenue section. And we're going to keep the P&L to its most basic form. Obviously, I'm just offering advice, so definitely refer to an accountant or bookkeeper or so like that, and they'll basically be able to be more in depth with what areas things should be at. But to continue, so after your revenue, you're going to have your cost of goods sold, which is formerly known as your COGS. So that's going to make up things like your fuel expense, if it's related to a job. It's going to make up things like the movers' direct pay, because basically you need the movers to be able to generate the revenue. So they're going to be located in your COGS section. There'll be a couple other things in there. You could probably put easy pass expense if you went through a toll to do that job. We used to put truck rental expense as well because, hey, we needed to rent a truck in order to do that job. So these are all direct expenses related to performing that move. So your COGS should be no more than about 50%, 50 to 55, but 55 is on the higher end. It should be 50% or less, so that basically you have about 50% left going into your general expenses. And your general expenses is basically what keeps your light on, which again, we got the utilities, your electric bill, your warehouse expense, your internet expense, your administrative payroll, your payroll, marketing. So that's going to be your general expenses. So after all of your indirect expenses, you should have about at least 9% left over or so like that. Now, there are some other non-operating revenue that comes in. So if you have a business savings account, that's going to be your other revenue, because that's not part of your normal day-to-day revenue. So your other revenue, which is going to be, I'm going to just type that in here. Your other revenue is going to consist of, like I said, interest revenue or any other revenue that's associated with your company gaining money that's not part of its normal day-to-day operation. Then you're going to have other expenses. And other expenses could be, let's see, what's other expenses? Something like maybe like you added a new business venture, or you had to pay taxes for your quarterly taxes or so like that. So like your quarterly taxes will probably be a good example, because this isn't a normal business expense. Again, refer to your attorney or accountant or whoever's handling your books. But basically, these are some of the things that we categorized as well in these areas. So you want to take these into consideration, because basically it's going to count towards your bottom line of what your net profit will be. And if your net profit is in the 6% range to 17% or so like that, you're doing really, really well. Now, this is obviously not going to be the end all be all to your money, and you're probably going to be wondering why. you don't have that money in your bank account. You're like, oh, well, hey, we made $100,000 and we have $6,000 on our bottom line. And I don't have $6,000 in my bank account. What's going on? Well, now the issue comes in is that basically that money went to other expenses that's on your balance sheet, such as if you had to make payments on your equipment that you're financing. That's items that's on your balance sheet that's not on your P&L statement. Now, if you had to make, if you pay your principal on your balance sheet, but your interest expense might be on your P&L. If you're taking a draw because you're not in the normal day-to-day operations of the business versus a salary every week, then your payment may be on the balance sheet. So now that 6% becomes even less because there's other expenses on your balance sheet that's not on your P&L statement. So you want to make sure you have enough wiggle room off of your P&L statement so that you can cover those expenses. So that's why it's very important to manage everything from your COGS to, which is basically the most important thing, is how much are you paying your movers? So if you're paying your movers an arm and a leg where you're like, well, damn, I want to make sure they get paid something, and they should be approximately at maybe 28% of your COGS. 28% is 28% of your revenue. Your revenue makes up 100%. 28% of that is saying that, well, hey, if I made $100,000, my movers outside of payroll taxes is getting paid about $28,000 for that month. So $28,000, okay, now you can allocate some more of those expenses towards your COGS. But if you're paying your movers $56,000 of $100,000, you're already at 56%, and you're already below the game. You're not even going to be. You might not even be able to keep all your lights on unless you cut some expenses. So that's going to be very, very important to know. So to get into it, we're going to look at some numbers. So this is an old statement. So like I said, you're going to have cleaning revenue, you're going to have customer discounts. If you had to give customer discounts, the reason why it's going to be negative is because basically it's more of a, again, we're not going to go into sophisticated terms, but it's like a contra revenue. So you're going to count that against your revenue. You have your junk removal revenue, moving services, packing services, paint and snow removal, whatever it is. You might even have your tips if you receive credit card tips revenue in here. From there, you even got, for us, we had, like, let's say we had travel revenue, U-Haul revenue, etc. Now you're going to get into your COGS. And your COGS, you're going to cover, so bank card fees may not be in COGS. That might be a general expense. But like if you had any day laborers, like from like any of the day laborers that's out there and that you contract, whether it's from a temp service or you hired them and you paid them $200 for the day, you want to have that in there. Your customer liability expense if you got claims, fuel, gas, packing supplies that you purchased. So you got the packing revenue up above. Then you want to make sure that you're keeping track of your packing supplies as well. And then, like I said, your movers direct payroll. This is outside of taxes. So here, we have about 19%. So we're in a pretty decent range for your mover direct payroll. Now, you're also going to have, whatever, your sales tax that you have to pay, your tolls, easy passes. Now, again, sales tax may be related to that job or maybe related to something. Sales tax could probably be a general expense, but, again, for today's video, we're not going to go over categorizing. And then, so at the end of your COGS, you have about 42% spent. And again, remember, based off the metrics, we want it to be around 50 to 55%. So now Oops. So now we have about 58% going into our general overhead, which is, yeah, like it says, overhead, which is keeping the lights on. So now you're going to have, whatever accountant, administrative, if you receive bank service charges, whatever it was. If you got vehicles, whatever, your marketing. So again, marketing, one of the conversations I had with one of the members is that, your marketing, you want to be between about 7 to 10%. And this is, in this example is 6.45%. So this is 6.45% of your revenue. So we did have, in this case, we would have had room to market a little bit more. And ultimately, this revenue is supposed to turn into, well, this expense is supposed to turn into more revenue. So that's the goal of your marketing percentage, and making sure that you regulate it so that you basically have more money on the bottom line. Now, if this number is like 13%, you could be overspending. Maybe there's a lead source that's not doing very, very well. So that's one of the things that you're going to want to use your market ROI report for, and make sure that you're keeping track of it. Another important expense here is going to be your administrative payroll expense. Now, this administrative payroll expense is going to be your operations manager, your yourself, your sales reps. Now this percentage here, you probably are going to want to get this percentage down. Now, again, this payroll, this is the general payroll, so I didn't break it out where we could see the administrative payroll. But this is going to be the taxes for the movers as well as the administrative person, and any other tax breakout. So we have 26% here, and we look at the mover direct payroll at 18% or 19%. Let's just say 19%. So 26 and 19, we'll say that's about 45%. So that's not bad for your overall payroll expense, 45% of your revenue. Because typically payroll is usually payroll with everyone is about half of what you make. So 45% is not a bad range for everyone. Now, if it was just you and just your movers, oh, you're probably crushing it at that point, because your payroll expense probably won't be near 45%. So that was another one. Let's see what else we have. So yeah, that was pretty much it in that area. And then you have your net operating income. So basically that puts you at 54, almost 55%. So that left us with about 3%. Now, looking at the metric table, we wanted to at least be at about 9%. So we're already behind the ball. We are already behind the ball. And basically at that point, we had to figure out what could be cut. And having these metrics and having these benchmarks is going to be helpful for your business, because basically if you know where each area of your business needs to be or should be, you could kind of start making those necessary moves to make sure that you fall right in line with where you want to be at the end of the day. So now, after other income, like I said, your interest income, and then maybe your line of credit interest expense, the net income was about 2.9%, which was way less than where we wanted to be, because again, as you've seen, we wanted to be about 6%. But because of our general expenses, that hindered that. So basically it only left us with, at the end of this period, like let's say $7,300, which wasn't very, very much. So that's basically the P&L statement in a nutshell. Is like, okay, hey, you know what? We got to break this up into 3 to 4 sections. And each of these 4 sections, we have to regulate how much we're spending and who we're spending with. So ultimately, you have to figure out if it's a need or a want in your business. Do we need let's see, for some examples. Do we need to be paying parking permits? Do we need to be paying a particular lead source? Do we need to be paying certain amount for like materials? Like, is there any alternative options that we can be exhausting to make sure that basically we are hitting where we need to hit? And ultimately, that's what it's going to come down to. So now, again, now this is what we had left. Now let's see how it carries over to the balance sheet. And basically on the balance sheet, you're going to have things like your assets, which is going to be, bank account, what you have in your bank account, what's your accounts receivables looking like, and then basically that's going to be your total current assets. From there, you're going to basically, if you have any other assets or like fixed assets, which is a business store that you completely own outright, or a forklift that's making you money, that's an asset. So if you have any other assets, that's going to basically go into your asset total. So basically, it's going to be assets minus liability and equity. So now you're going to look at your liabilities. Okay, well, hey, what liabilities do I have? Oh, well, I have a line of credit. I have, some type of business credit card or something like that. Whatever type of liabilities the company has that's, like loans or something like that, it's going to be considered a liability against the business. And then whatever equity you have in your business, it's going to be basically, it's basically going to be that. And then basically it's going to be like I said, your assets and your liabilities should equal out. If it isn't equaled out, then there's an issue in the accounting software. So definitely recommend going with a bookkeeper. ProMover Accountant is probably going to be a great resource to go to if you're a moving company, because they focus strictly on moving companies. Again, that's ProMover Accountant. I have their resource on my webpage in our resource section, so definitely check them out. Okay, so that's basically your balance sheet in a nutshell. It's a lot to look at, but it's not a lot to look at. Your P&L is pretty much, you're going to spend about 70% of your time on the P&L statement. Now, the most underrated statement that a lot of people don't look at, which is their statement of cash flow. Their statement of cash flow is going to be all the money that you're bringing in at one particular time, if you have any financing activities, if you have, and then pretty much all the money that's going out. So it will say like cash at the beginning of the period, and then cash at the end of the period. And these are really the two line items you want to focus on. Oh, well, hey, I brought in this much and I ended with this much. Okay, that don't sound too bad. And most people say, well, hey, I'll just look at my bank statement. And you definitely could look at your bank statement and see how much money you had at the beginning of the month and how much money you got now in your account. But this just gives you an overview, and probably a briefer overview of what you actually have. But again, it is a underutilized statement. And then so that is the financial statement in a nutshell. One of the examples I used for the P&L statement was, let's say that you brought in a total revenue of $2,400, $422. Your direct expense, which is your COGS, was $1,211. That was about 50%. So that's going to leave you with 50% left, which is $1,211. Your indirect expenses was about 40%. That's going to be about $968.80, leaving you with $242.20 before going into your other income / expenses. Your other expenses end up being $26.64. So it left you with a net profit of just under 9% at $215.56. And these were using, like I said, using small numbers to give you an idea that if this was $200,000, you would have spent $100,000. You would have then spent $40,000. You would have then spent another $10,000. You would have probably came away with probably $9,000 when it was all said and done. So, you could do it from any size company. The math and the logic works no matter if you're a $2 million, $3 million, $4 million company to if you're only making $100,000 a year. So that's the financial statements in a nutshell. Go over to another fun report since we have a little time. And this is the sales by product / service summary. This is going to be very, very important if you pay attention to it. And it looks like a lot, but it's really not a lot. This basically summary basically tells you how many of a line item product you sold. So if you sold a 2-man labor service, now this is when you break out like in your CRM. If you say, hey, I'm going to put a 2-man on this job. I'm going to put a half an hour travel on this job. I'm going to put I'm going to add, door floor protection or whatever. I'm going to offer a discount. This is going to keep track of how many 2-man jobs you performed, or how many 2-man jobs you either performed or how many quantities. So like if your 2 men were out there for 534 hours, 34 hours. That's basically what this is saying. So that's a crucial sign to saying that, okay, well, hey, my 2-man is definitely selling. And off that 2-man selling for that many hours, I made this much from the 2-man service. Okay. And out of the total 100% revenue, it makes up 18.5%. Okay. Now let me look at my 3-man. Okay, the 3-man is been out there a little bit longer, and it makes up 26%. Okay, interesting. Now the 4-man, you start to say, oh wow, my 4-man is literally half of all of these. Okay, that means we're not really getting that many big jobs. So your numbers are painting a picture. You just have to see what picture those numbers are painting for you. So now you say, well, that 4-man only made up 13%, but my 2-man made up 18%. How can I either get more 3-man jobs, 4-man jobs, 5-man jobs, 6-man jobs, whatever, and less of my 2-man services? So if you're just in a smaller market where you're just selling 2-man jobs like hotcakes, what you could do is add a little, I call it a penalty, but add a little extra on your 2-man services. So if your normal hourly service is $50 per man, with a 2-man service, add extra $10, extra $15. So now it's like your 2-man is worth $60 or $65. So that now you make more money off of your 2-man services for people wanting to use your 2-man services, and you can keep the 3-man, 4-man, 5-man services moving as normal. So that's one way you can do it. Or you could tell them, well, hey, you know what? Our 2-man services is a little bit more expensive because of where we usually get pretty busy, and because we know that our guys are always out there. We rather not send 2 guys out to jobs. So if you do go with our 3-man, we can definitely look to save you some money today. And that could be a conversation you have with your customers. Let's see. So again, if you're constantly using U-Hauls, you can keep track of that as well. But obviously U-Haul is going to be a major expense towards you, not a revenue earned. But your truck your truck revenue will be. So anytime you offer a truck, you can say, oh, well, hey, I made this much off of my trucks or whatever the case is. Here's my percentage. Okay, well, that's 16% of my total revenue. You can look to try to get your truck revenue up. If your truck revenue is, obviously, people need full service work, that's going to be there regardless. If you're not charging a travel fee, you could be charging a travel fee to get your revenue up. I know some people do fuel surcharges. We were never a fan of doing fuel surcharges only because it just, it didn't really add up. Plus, there's some unbillable hours that you have to consider with your guys. Oh, well, hey, they got there early. Okay, well, they brought the truck back. Are you paying those guys for that amount of time that they're driving technically off the clock? So you have to realize, you have to figure that out. And I felt like the fuel surcharge would not cover that in particular. So we had a different method of how to cover that expense where basically it would be covered. And for us, that was using the travel revenue. So yeah, that was, like I said, this is a very, very cool report. So if you are using like QuickBooks or so like that, you can, if you are line iteming out, pretty much separating out all of your line items, you could basically be able to pull a report like this. So again, it's called sales by product / service summary. So again, that was the financial statement in a nutshell. If you have any questions, definitely don't hesitate to reach out. You can visit maxmovingtraining.com and schedule a free consultation if you have more questions about this, or join the Facebook group, Running a Profitable Moving Company, where this is all we talk about is training. All right, y'all. So we are going to take off. I hope this was valuable, and I will catch up with y'all soon. All right, later.